The Securities and Exchange Board of India, or SEBI, has introduced a new asset class, marking a significant development for Indian investors. This new category aims to bridge the gap between traditional investment options and sophisticated portfolio management services. It caters to a specific segment of investors, those who seek higher returns than fixed deposits or traditional mutual funds but may not have the capital required for portfolio management services or PMS. This new asset class opens doors for mid-range investors to access a wider range of investment strategies previously unavailable to them. This move signifies SEBI's commitment to making investing more inclusive and providing diverse options for wealth creation. By introducing this new asset class, SEBI aims to empower investors with more choices to align their investments with their financial goals. The move has the potential to reshape the investment landscape in India by offering a fresh approach to portfolio diversification and risk management. Unlike traditional mutual funds, which are primarily categorized based on asset classes like equity, debt, or hybrid funds, SEBI's new asset class focuses on investment strategies. This means investors can choose funds based on how they aim to generate returns rather than just the underlying assets. One prominent example is the long-short equity fund. This strategy allows fund managers to profit from both rising and falling markets. They take a long position in stocks they anticipate will grow and a short position in those expected to decline. This dynamic approach provides an opportunity to generate returns irrespective of market direction. Another intriguing strategy is the inverse ETF or fund, designed to move in the opposite direction of a benchmark index. When the market declines, an inverse ETF aims to generate profits, acting as a potential hedge against market downturns. This feature makes it an attractive option for investors seeking to mitigate losses during volatile market conditions. SEBI's new asset class isn't entirely unprecedented. Similar alternative investment strategies have existed in developed markets like Europe, the United States, and Australia. Often referred to as hedge fund-light strategies, these investment vehicles emerged after the 2008 financial crisis as investors sought ways to diversify their portfolios and manage risk more effectively. The introduction of these strategies in Western markets stemmed from a need to provide everyday investors with some of the sophisticated investment approaches previously accessible only to high-net-worth individuals and institutional investors. However, the performance of these liquid alternative funds, as they are often called, has been a subject of debate. Section 4. Potential rewards, aiming for higher returns. The primary allure of SEBI's new asset class lies in its potential to deliver higher returns compared to traditional investment avenues. By employing diverse and dynamic investment strategies, these funds aim to capitalize on market opportunities that may not be accessible through conventional investment approaches. For mid-range investors seeking to grow their wealth at a faster pace, this new asset class presents an opportunity to potentially outperform traditional investments. However, it is crucial to remember that higher returns come with inherent risks, and investors should carefully assess their risk tolerance before investing. Section 5. Navigating the risks, a balanced perspective. While the potential for higher returns is enticing, it's crucial to approach this new asset class with a balanced perspective. The historical performance of similar liquid alternative funds in other markets suggests that achieving consistent outperformance is not guaranteed. These funds may sometimes struggle to keep pace with broader stock and bond markets, especially during periods of strong market rallies. Moreover, the complexity of these strategies often translates into higher management fees compared to traditional index funds or ETFs. Investors need to carefully evaluate the expense ratios of these funds to ensure that the potential returns justify the costs involved. Section 6. A prudent approach for Indian investors. SEBI's new asset class presents an intriguing addition to the Indian investment landscape. It offers mid-range investors an opportunity to access sophisticated investment strategies previously out of reach. However, it is essential to approach this new avenue with a cautious yet optimistic outlook. Before investing, conduct thorough due diligence, understand the investment strategy involved, and carefully assess your risk appetite. Consider this asset class as a part of a well-diversified portfolio rather than a standalone solution for wealth creation. Remember, prudent investing involves informed decision-making, a long-term perspective, and a realistic understanding of both the potential rewards and inherent risks.